Matt Camuso, how have ETF inflows been for active ETFs so far in this fairly volatile market? At least it was pretty volatile in the spring.
It was. I know we continue to see volatility, but a short answer is they perform very well. So active ETFs especially continue to be a bright spot for fund managers across the industry. So if we look at so far this year, 260 billion roughly into active ETFs, which is just yet another record. I think when you double click into the flows, it's a little interesting to see US equity for active ETFs as the top category, given that's where we've seen kind of the most volatility in the equity markets year to date, followed by US fixed income. And then global equities has started to tick up. But again, look back to the first half of this year, they were really in kind of a performance headwind. We just didn't see the flows yet. So all in all, we continue to see that appetite for active ETFs, even through market volatility so far this year.
Can you explain this huge surge into active ETFs for me? Because not too long ago, everyone wanted to be into passive ETFs because they were low cost, they followed an index. But perhaps is it because of the volatility? People think they can beat the market now?
So I think it's twofold. So for one, there's just more product choice, which is leading to more flows. So if you look at just the past year and a half, there's been over 900 active ETFs brought to the market. So that's a piece of this. It's not just volatility and people choosing active again. However, I think in times of volatility, we do see that appetite for active tick up. So that's really twofold. Either that's for diversification or alpha drivers, but you need that kind of divergence of return, whether that's a little bit more market breadth or the divergence of return, like we were just mentioning, of the international markets outperforming US, when most clients we talk to in portfolios we look at are very heavy into the US equity allocation. It's times like these that is kind of brought to light, and they're going to want more of that international. Most of the times, if you look at kind of where the best opportunity for active is in the equity markets, it is in that international developed or emerging market equity space, just more probabilities for outperformance. So I think it's both of those things, but we can't forget there's just more product out there today that is also leading to this return.
And is it safe to say that all that product in actively managed ETFs is just taking a whole lot of share from good old-fashioned mutual funds? Or is it separately managed accounts? Or is it the passive ETFs? Where are they taking it from?
If you look at some of the flow trends, I think you can argue, although it's not perfect in one for one, it's coming from mutual funds. And clients that we talk to, even using the same exact strategy in an ETF that wasn't a mutual fund, leveraging now that ETF for tax efficiency. I also think with the amount of product out there right now, there's a lot of really unique and innovative products coming to market that help complement passive really well. So it's not this wholesale replacement of going from beta to active. It's using diversifiers to do that core satellite. So lower volatility, increased income, do some sort of outcome using an active ETF that's complementing that passive. But if you just, again, look at flow trends, you could argue a majority of this active ETF flow is coming from the mutual fund space.
So what are you doing over at BNY to help advisors and investors navigate this trend towards active ETFs? Are you telling them, get out of your passives, get into the actives? How are you doing it? What's your strategy?
Yeah, so we've been hyper-focused on building out our active ETF lineup over the past even 3 to 5 years. Right now, we offer 8 active ETFs. A lot of the conversations we're having are around kind of 2 different things for active. One is an alpha generator. So BKDV is our dynamic value ETF. This is a clone ETF from our kind of most successful mutual fund. This is an alpha generator. If you look at the mutual fund strategy, you have alpha over the Russell 1000 value index on a 1, 3, 5, and 10-year basis. So here's a great opportunity to replace passive and go with an alpha generator or use your fee budget. There's also the diversifier. So we have an infrastructure ETF, a global infrastructure income ETF, which is ticker BKGI. Now, just infrastructure businesses by nature have more defensive characteristics. So BKGI can bring a nice low beta. If you look at the beta to the S&P 500, it's roughly 0.4 year to date on a 2-year basis. That's a great 5 to 10% allocation to lower the overall volatility of the portfolio. So again, those kind of 2 use cases, replace for active with BKDV for that alpha generator, but also bring in more of a defensive equity diversifier with a BKGI.
And then finally, what's your outlook for the next 5 years or 10 years when it comes to ETFs? I just said we've seen a tremendous switch from mutual funds to passive ETFs. Now actively managed ETFs have taken the baton. Where do we go from here?
I think it really is to start more of the same. So a lot of our clients are asking, is this a fad, right? Is this just a quick trend? We say absolutely not, because yes, it's been a trend, but that trend has been accelerating. Flows for active ETFs have increased year over year for the past 5 years. Product launches have increased year over year for 5 years. New entrants have increased year over year for 5 years. So we absolutely think it's here to stay. I don't think innovation is stopping either. I think there's a world, especially with some catalysts like ETF as a share class, that in 2 years from now, we're looking at active ETF assets of $2.5 trillion from the $1 trillion they are today.
All right. Well, thanks for coming on and talking about it.
Thanks for having us, Greg.